6.3%. That's the number defining homeownership in 2026. Not the 3% dreams of 2021. Not the 7% nightmare of 2024. The new normal. If you're a first-time buyer staring at these numbers wondering if homeownership is still possible, today we're cutting through the noise to give you a realistic roadmap. I'm going to show you where the opportunities actually exist, which strategies work, and when renting might still be the smarter financial move. Here's what's different about 2026. For the first time since 2020, monthly mortgage payments are actually expected to decline. That's not just a talking point, it's a trend shift. The typical mortgage payment may finally dip below 30% of household income. That threshold matters more than you might think. But here's the catch. Improvement doesn't mean easy. Only 35% of U.S. markets have homes affordable for buyers in their 20s and 30s. So let's break down exactly what you're working with and how to make the math work in your favor. First, let's understand how we got here. The pandemic created something economists call the lock-in effect. Millions of homeowners refinanced at rates near 3%. Those homeowners now refuse to sell because giving up that rate feels like throwing away free money. They're essentially trapped in their own homes by a good deal. This has constrained inventory nationwide. Fewer homes on the market means more competition for what's available, which keeps prices elevated despite higher rates. For first-time buyers, this creates a frustrating paradox. You're competing for limited starter homes at prices that feel disconnected from what you can actually afford. But 2026 brings some genuine improvement. Rates are stabilizing. Builders are responding. And for the first time in years, the math is tilting slightly back toward buyers. The question is whether these improvements are enough, or whether renting and investing the difference remains the mathematically superior choice in many markets. Let's start with the headline number. U.S. mortgage rates are expected to hover near 6.3% in 2026, down from 6.6% in 2025. That 30 basis point drop doesn't sound dramatic, but on a $400,000 mortgage, it saves roughly $60 per month. Real money over 30 years. According to Redfin, monthly mortgage payments are expected to decline for the first time since 2020. That's the signal that caught my attention. The National Association of Realtors forecasts a 14% nationwide increase in home sales for 2026. More activity means more inventory, more options. Here's where it gets interesting. Experts disagree significantly on where prices are heading. NAR expects 4% price growth. JP Morgan expects 0%. Completely flat. Zillow lands in the middle at 1.9% growth. That's a wide range of predictions, and it tells you something important about uncertainty in this market. Why such disagreement? Regional variations are stark. The Northeast and Midwest are seeing faster price growth while the South and West are softening. The Sunbelt boom that defined pandemic migration is cooling. Cities that saw prices surge 30% are now experiencing stabilization, sometimes even slight declines. Here's the affordability reality check from HousingWire. Only 35% of markets have median-priced homes affordable under the 30% income guideline for 25 to 34-year-olds. That 30% threshold isn't arbitrary. It's the traditional guardrail lenders and financial planners use to define a sustainable housing payment. When your mortgage exceeds 30% of gross income, you're in what's called cost-burden territory. Less room for emergencies, less ability to save, more financial stress. Now here's where builders are creating opportunity. According to HousingWire, roughly 40% of builders cut prices on newly built homes at the end of 2025. Average reductions were around 5%. On a $350,000 home, that's $17,500, a meaningful discount. Even more significant, 2/3 of builders offered incentives like mortgage rate buydowns. This is where the real opportunity lies for first-time buyers. A rate buydown works like this. The builder pays up front to lower your interest rate for the first 1 to 3 years. It reduces your initial monthly payments significantly. A 2-1 buydown, for example, might drop your rate 2 points the first year, 1 point the second year, then normalize to your locked rate in year 3. The catch is your payment will increase each year until it reaches the full amount. You need to plan for that step up and ensure you can handle the eventual higher payment. Builders are also responding to affordability constraints by building smaller and building different. Townhomes now account for 18% of single-family construction. That's up from less than 10% a decade ago. Townhomes offer lower price points, smaller footprints, and often shared amenities that reduce maintenance costs. For first-time buyers who've been focused exclusively on single-family detached homes, expanding your search to include townhomes and condos could open significant new inventory. Let me share a quote from NAR's Outlook. Modest home price gains, declining mortgage rates, and higher household incomes will together help make housing more affordable across the country. That's the optimistic view, three tailwinds converging. But notice they said, more affordable, not affordable, not affordable. The improvement is relative to where we've been, not where we need to be. So what strategies actually work in this environment? Let's talk about adjustable rate mortgages, ARMs. They're back in the conversation, but you need to understand what you're signing up for. A lending expert quoted in HousingWire put it plainly. ARMs are a short to medium-term affordability tactic, not a long-term strategy. An ARM can make sense if you're confident you'll refinance or move within 5 to 7 years. The initial rate is lower, which improves your monthly cash flow today. But understand the risk. If rates don't drop and you're still in that home when the ARM resets, your payment could jump significantly. Plan for that scenario. The rent versus buy calculation is the decision that matters most, and it varies wildly by market. In some cities, renting and investing saves hundreds of thousands over a decade. Here's what I'd suggest. Run the rent versus buy numbers for your specific market using calculators from Zillow or NerdWallet. Don't assume buying is automatically the right move. These calculators factor in home appreciation, rent increases, tax benefits, opportunity cost of your down payment, and transaction costs when you eventually sell. In high-cost metros like San Francisco or New York, the numbers often favor renting for longer than people expect. That's not failure. That's financial optimization. In more affordable markets, parts of the Midwest, smaller cities, buying can still make clear financial sense even at current rates. Geography matters enormously. Look actively for builder incentives. Rate buydowns can effectively lower your rate 1 to 2% for the first few years. Combined with price cuts, the savings compound. Consider townhomes and condos as entry points. They're increasingly where builders are focusing affordable inventory. Your first home doesn't have to be your forever home. The 30% income guideline remains a useful guardrail. If a mortgage would exceed 30% of your gross income, you may be stretching too thin regardless of market conditions. There's nothing magical about that number, but historically, households that exceed it report higher financial stress and are more vulnerable to income disruptions. Northeast and Midwest markets may offer better value than overheated Sunbelt cities. The pandemic migration that drove prices up is slowing, creating pockets of opportunity. Cities like Cleveland, Pittsburgh, Indianapolis, and Buffalo offer median home prices well below the national average with relatively strong job markets and improving amenities. Remote work has made these markets more accessible to buyers who once needed proximity to coastal job centers. If your employer offers flexibility, your geography options expand significantly. Remember, experts predict 14% more sales activity in 2026. More transactions mean more negotiating power for buyers and potentially more motivated sellers. The lock-in effect that's been freezing inventory may finally start to thaw. Life events don't pause for favorable interest rates. Divorces, job relocations, and growing families still happen. Some homeowners who've delayed selling will reach the point where holding onto their low rate no longer makes sense for their circumstances. That inventory will help. If you're pre-approved and ready to move, spring and early summer 2026 may offer the best balance of inventory and buyer leverage we've seen in several years. But if you're not financially ready, if buying would push you above that 30% threshold or deplete your emergency fund, waiting is not losing. Renting while investing, the difference in a diversified portfolio has historically generated strong returns. The throwing money away on rent narrative is mathematically oversimplified. A home is an asset, but it's also a liability. Property taxes, maintenance, insurance, and opportunity cost on your down payment are real expenses that offset appreciation. The smart move isn't to follow one-size-fits-all formula. It's to run your specific numbers with your specific variables and make the decision that optimizes your financial position. Before you make any offers, stress test your budget. What happens if you lose your job for 3 months? What if a major repair hits? Can you still make payments? Most financial advisors suggest having 3 to 6 months of expenses saved beyond your down payment. That buffer prevents a mortgage from becoming a financial prison. The first-time buyers who succeed in this market won't be the ones who stretch to their absolute maximum. They'll be the ones who buy within their means with room to breathe. One more data point to consider. The Urban Institute highlights that housing affordability challenges vary significantly by race, income level, and geographic region. First-generation homebuyers and buyers without family wealth for down payment assistance face steeper climbs. Programs exist to help state and local down payment assistance, FHA loans, VA loans, if you qualify. Research what's available in your state. Many first-time buyer programs are underutilized simply because people don't know they exist. HUD-approved housing counselor can help navigate options. The 2026 housing market isn't easy for first-time buyers, but it's more navigable than 2024, and for those who approach it strategically, opportunities do exist. Let me leave you with this framework. The 30% guideline, a 6-month emergency buffer, and patience to wait for the right opportunity. Those are your anchors. If the numbers work in your market and your financial position is solid, 2026 offers real opportunity. If they don't work, that's valuable information too. Quick reminder. This content is educational only and doesn't constitute financial advice. Please consult with a qualified financial advisor before making any investment decisions. I'm your host at Money Moves Daily. Run your numbers, know your limits, and make the move when it's right for you, not when someone else tells you it's time.